Diane King Hall is in New York. Let's go there. Let's talk some more chips. Let's talk some analyst notes, a couple big sectors, including the home builders. Diane, one that is concentrated on semiconductors from Citi, but more so on some of the fabrication businesses, which have already been ailing. So are they just kind of confirming the situation, or are they saying they're going to break down more?
Well, it looks like the expectation is that demand in that sector will shrink in 2025. That's the outlook when it comes to the equipment used to make the chips. In other words, the wafer fabrication equipment. Those are the machines that makes the semiconductor equipment. So those that Citigroup expects to be impacted by that would be AMAT, Applied Materials, KLA Corp, and of course LCRX. That would be Lam Research. Apologies, I had to just take a quick look back at the note. What their concern is, there's a couple headwinds that they see facing these companies. One is just the demand picture when it comes to logic, and what they mean by logic is just the chips that support, say, the smartphones, computers, and those kind of equipment, and industrial equipment, et cetera. They expect to see some reduction in demand in 2025 there, and they expect spending on that type of equipment to drop by about $9 billion. They also expect to see a decline in spending by China, so they're reducing their outlook for the sector in general. They've cut their wafer fab equipment estimates by about 5%, so they've lowered their price targets across the board for Applied Materials, for Lam Research, and for KLA. They just see maturing in this sector, and they see weakness in the maturity there. AMAT, they've lowered the price target on Applied Materials to $194 a share from $217, but they still have a buy rating on the stock. But again, they just see a decline in demand there, weak PCs spin, and they say that there's no killer application in sight. That's a quote. So they've adjusted all their estimates and price targets off the back of this. So you're not seeing any major impact to this today, and obviously throughout this year, we've seen some trouble within this sector. For KLA Corp, they've lowered the price target to $832 a share. They still keep a buy rating on the stock, and for Lam, they've lowered the price target to $87 a share from $90, and they also still maintain a buy rating on the stock.
Okay. The levels that they're expecting, the price targets are not disgusting. You know, they're they're all above, right, where they're trading. So as far as like broad-based cuts and like downgrades go, it sounds like they're kind of catching down a little bit to where the stocks have already been. In fact, technically, like a few like Lam and maybe ASML, which is kind of in the same category, look like they're trying to pick up a little bit, but it's still notable that they've kind of thrown in the towel to some extent on some of the fab businesses. So, all right, it looks like just a repricing of the demand they see.
That's what I was going to say. It just looks like a repricing or resetting of these targets based on the outlook for 2025 and just a little bit lower outlook. And so a little bit of catch up. And I mean, we're going to see analyst notes like this through the close of this year, just kind of what are the new targets for 2025 based on the expectations, especially when you think about China and what the demand picture has looked like there and what the spend has looked like there. There's still, you know, we know there's all these stimulus measures in place, but demand hasn't caught up in general.
Okay. Let's talk another negative comment out. This one from Wells Fargo on the home builders. I mean, honestly, I think so many times in the first half of this year, I described the home builders and the semis as the two most important groups. So it's kind of interesting here that while the market's been doing so well, you've got negative commentary on these two very important sectors.
Yeah, there had been a little bit of, some recovery within home builders, but again, they're more and more analysts have been downbeat again on home builders now. So Wells Fargo now lowering its price target on D.R. Horton to $175 a share from $190 a share. They are maintaining an overweight rating on the stock. In terms of the outlook overall for the home builders, there's just some pessimism rising around it, and they say for 2025, the picture basically looks murky, and the playbook is complicated for the builders and products. And they say the opportunities to move up the risk curve will eventually materialize, but they're not there yet. So they've also lowered the price target on KB Home to $74 a share from 183. They're keeping an underweight rating on that one. For Lennar, they've lowered it to 165 bucks a share from 180, keeping an equal weight rating on that. And for Pulte, they've lowered the price target to 140 bucks a share from 165, keeping an overweight rating on that. And circling back to D.R. Horton, another bank also cutting their price target. That's Bank of America. They've cut it close to the same level as Wells Fargo. They've cut it to 170 bucks a share. Previously, they saw it at 190 bucks a share. So a little ding, not playing out in terms of the market reaction, but D.R. Horton's had a difficult year. Year to date, that stock is pretty flat. It's, off a percent year to date. KB Home has done better this year, but certainly trailing the S&P 500 in terms of Lennar year to date. Very little movement there. Pulte has done better, similar to KB Home, but again trailing the S&P 500.
Yeah, pretty rough chart for a lot of these as they've pulled back pretty severely. So this morning, not responding too much to this note, but again, it seems like reacting to the price movement to the downside. Not necessarily saying they're going to crash a ton further, but still negative for sure. Hey, something that is positive though, Barclays, some of the fintech stocks they're liking.
Fintech, yeah. Yeah, they are. They like PayPal. They're raising the price target on PayPal to 110 bucks a share from 92, maintaining an overweight rating on the stock. And PayPal has had a really good year. They say in terms of fintech, what the outlook is, it's, quote, finally improving. Going into 2025, valuations appear to be trending back towards average historic levels, and they just more constructive on fintech names. It's not the only one they're constructive on. They've raised the price target on Block to 112 bucks a share from 100 bucks a share. They're maintaining an overweight rating on the stock. And Barclays saying in terms of this, play stocks whose moves are only half finished. Both of these stocks have performed well this year. PayPal better than Block this year, but both beating the S&P 500.
All right. Yeah, the comeback in PayPal has been fun to watch. Seems like it's catching some more appreciation here. 2 quarters in a row now, and stock's been moving up. Thanks, Diane. Great stuff.